studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
One of the most common situations encountered in owner-managed corporations is the existence of a shareholder balance. In theory, shareholders should receive money from their corporation through properly structured compensation methods such as salary or dividends. However, in practice, many business owners simply take money from the corporation whenever they need it. Throughout the year, an owner may write a check to themselves, transfer money from the corporate bank account to their personal account, use a corporate debit or credit card for personal purchases, or pay personal living expenses directly from the business account. From the owner's perspective, these transactions often seem harmless. After all, they own the corporation. But from an accounting and tax perspective, each withdrawal must be recorded somewhere. As these transactions accumulate during the year, they are typically recorded in the shareholder loan account. This account acts as a running record of money moving between the corporation and the shareholder. The issue becomes apparent at year-end when the accountant reviews the records. Imagine a situation where the owner has withdrawn $85,000 during the year, but no salary has been declared and no dividends have been paid. At that point, the accounting records may show a shareholder loan balance of $85,000. In other words, the books indicate that the shareholder has received money from the corporation without any formal compensation arrangement. This is exactly why shareholder balances are so common in small businesses. Most owners are focused on operating their business, paying bills, and managing cash flow. They often withdraw money based on personal needs rather than following a structured compensation plan. For tax professionals, this year-end review is critical. A shareholder balance is not simply an accounting entry. It is often the starting point for determining whether additional tax consequences may arise and what adjustments need to be made before the tax return is finalized. Understanding how these balances are created is the first step toward understanding the shareholder loan rules that we will examine in the sections ahead. Now that we understand how shareholder balances are created, the next question is, what exactly is a shareholder loan account? Many people assume it is a special bank account or a formal loan agreement. In reality, it is simply an accounting record that tracks financial transactions between a corporation and its shareholder. Think of it as a running scoreboard that keeps track of who owes money to whom. On one side, the corporation may owe money to the shareholder. This happens when the shareholder contributes funds to the business, pays corporate expenses personally, injects additional capital, or helps cover cash shortages. In these situations, the shareholder has effectively advanced money to the corporation. This generally creates a credit balance in the shareholder loan account. A credit balance is usually not a problem. In many cases, the shareholder can withdraw those funds later without creating additional taxable income because they are simply recovering money that was previously contributed to the corporation. On the other side, the shareholder may owe money to the corporation. This occurs when the shareholder withdraws cash, pays personal expenses through the company, uses corporate assets for personal purposes, or takes money out of the business without properly recording it as salary or dividends. These transactions generally create a debit balance in the shareholder loan account. A debit balance is where tax professionals begin paying close attention. A large debit balance may indicate that the shareholder has received value from the corporation that has not yet been properly addressed for tax purposes. Throughout the year, every transaction is added to this running balance. Money flowing into the corporation generally moves the balance in one direction, while money flowing out to the shareholder moves it in the other direction. As a result, the shareholder loan account continuously changes as transactions occur. The most important concept to remember is that the shareholder loan account is not the problem itself. It is simply a tracking mechanism. The account tells us whether the corporation owes the shareholder money or whether the shareholder owes money back to the corporation. For tax preparers, this account becomes one of the most important areas to review because it often reveals transactions that may have significant tax consequences under the shareholder loan and shareholder benefit rules that we will study next. At this point, we understand how shareholder balances are created and what the shareholder loan account represents. The next question is why accountants pay so much attention to these balances. The answer is simple. A large shareholder loan balance, especially a debit balance, is one of the first things an accountant reviews during year-end preparation. When preparing financial statements and tax returns, accountants carefully examine owner withdrawals, personal expenses paid through the corporation, loans and advances, reimbursements, and situations where corporate assets may have been used for personal purposes. The reason for this review is that a shareholder loan balance often tells a much bigger story. It can reveal how money has moved between the shareholder and the corporation throughout the year, and whether those transactions have been treated correctly for tax purposes. From the CRA's perspective, a large debit balance can be a warning sign. It may suggest that a shareholder has received value from the corporation without reporting it as salary, dividend, or another properly structured form of compensation. As a result, CRA auditors may look more closely at unexplained withdrawals, shareholder loan balances, personal benefits received from the corporation, and whether the overall tax treatment complies with the Income Tax Act. This is why large shareholder loan balances can create several risks. First, there may be additional taxes if amounts are reclassified as taxable benefits or other forms of income. Second, interest charges may apply if the shareholder loan rules require an income inclusion or an imputed interest calculation. Third, penalties may arise if required reporting has not been completed correctly. And finally, large balances can increase the likelihood of additional CRA scrutiny or audit activity. To manage these risks, accountants typically follow a structured year-end process. They review all withdrawals and transactions, calculate the shareholder loan balance, determine the appropriate tax treatment, and make any necessary year-end adjustments. For many small business accountants, this is one of the most common and important areas of tax planning and compliance. A properly analyzed shareholder loan account can help prevent unexpected tax bills, avoid CRA reassessments, and ensure that the owner-manager's compensation strategy is both tax-efficient and compliant with Canadian tax rules. This is why shareholder balances are not merely bookkeeping entries. They are often one of the most important indicators of potential tax issues within an owner-managed corporation.